Okay, so the first question you're probably thinking to yourself is, why do I even want to listen to these people? Who are they that are going to actually tell me something that that would be of value to me? So a really quick overview of who we are, and this is both Steve and myself. We're 20 years in the business, so AIS Solutions celebrated its 20th anniversary in July. We've been nominated and have won as Top 50 Cloud Accountant. So a couple of awards and accolades within our industry, Global Firm of the Future, which was amazing for us. We also specialize in the e-commerce space. We're going to talk about it in probably the next slide as to why e-commerce is a little bit different. But more than anything else, I think this is the big one for us, is that we have actually been an e-commerce retailer, not just from the accounting and bookkeeping side, but from the front end side. So although Steve said that, probably talking about packaging wasn't going to be something we would cover, it definitely isn't, but we understand what you're talking about when you talk about it because we've been there. And then the last piece is trainer writer. We do teach within the industry other bookkeepers on cloud accounting platforms and bookkeeping topics. So that's a little bit about us. So what are we going to do over the next 30 minutes or so? We're going to talk about, again, just so that everyone is on the same page, we're going to talk a little bit about the basics of profitability. I think it's one slide. We're going to dive into gross profit margin, true costs of product, your customer acquisition cost. We're going to go through a comparison example as well. And then again, open up and answer the Q&A that come up through the course of the next 30 minutes. Any questions so far? I think it's pretty straightforward. This is probably the easy part of it. Okay, so e-commerce bookkeeping is different. So bookkeeping is bookkeeping, or at least that's what everybody thinks, until you get to e-commerce bookkeeping. It's one of the industries that you can't say that it's bookkeeping is bookkeeping is bookkeeping. There's a lot of additional things that you have to consider, and probably clearing accounts become your best friend in e-commerce bookkeeping. But not only that, if you have a retail store, a traditional brick and mortar store, your customers walk in through the door, and so you only have to deal with the sales tax within your province. When you are an e-commerce bookkeeper or an e-commerce retailer, your customers are across the country, they're across the continent, they're across the world. So you do have different sales tax implications. So that's a significant difference between an e-commerce retailer and a bricks and mortar retailer. Inventory, another big differentiator in the e-commerce space. If you think about if you are selling on multiple channels, you're selling on Amazon, you're selling on Shopify, you sell something on Shopify. You want to make sure that your Amazon, you don't also sell it on Amazon because you no longer have it. So being able to track inventory across your multiple channels is definitely a big consideration. And then probably the other one, which tends to be overwhelming for most e-commerce retailers, especially if you're selling on various platforms, are all the various fees. Amazon has this whole slew of fees with lots of different names, lots of different types of fulfillment and charges. Shopify, same thing, Shopify fees. So that is something that is different to an e-commerce retailer. And so all the bookkeeping behind it is also different.
Juliette, sorry, one thing perhaps you did mention something called a clearing account.
Yes.
There would be many business owners, some who are probably with us today, who would have no idea what that is or why they should even care. Can you perhaps just give a very quick, brief explanation of what that is?
What a clearing account is? I'm not sure I can give a brief explanation. It's probably a 40-minute or 50-minute webinar all on its own. Basically, clearing accounts are used in the e-commerce space when you have multiple sales channels. So for example, you are using PayPal as a payment method to collect from your customers, but you're using PayPal from your Shopify sales and your Amazon sales. So you would need a clearing account to capture all the sales and capture all the payments because they're coming from multiple sources. Does that, that make sense?
Okay. I didn't want us to just go right by that without having a brief explanation of it, so thank you.
No problem. Okay, so as I said, just so that everyone is on the same page, we're going to talk about one slide, which is about profitability. And the definition of profitability is also used interchangeably with the word gross profit, and you will hear me refer to it in both scenarios. So basically, it's a really simple formula. Your profitability is your revenue minus your cost of product. Revenue, really straightforward, your total sales. What you sell, again, not including taxes, but what you sell your products for. And from the revenue, you subtract the cost of your product. It can be straightforward. It may not be straightforward. We're going to talk about two examples of where it's straightforward and where it's not in a minute, but that's basically your formula for your gross profit. It's the difference between how much you get from your customer for your product and how much it costs you to make that product. And that is your gross profit. Okay, so here is a really simple example. And for the women in the audience, of course, I did jewelry. So, because I'm kind of a jewelry fanatic. So this is going to be a really straightforward example. You're an Etsy seller, you're selling your jewelry, you make it yourself, and you sell a necklace for $35. There's your revenue number from that formula that we just looked at. So $35 is your revenue, and it costs you $15 to buy the wire, to buy the hooks, to buy the chain maybe, to buy the stones or the beads that you put, all the pieces that you put into the necklace to create it, cost you $15. So if we go back to our example, can we go back a slide here? If we go back to this slide, your revenue is $35, the price you sold the necklace for. Your cost of your product is $15, so your profitability or your gross profit, $20. Really straightforward. So now let's look at a little bit more complex example. You're selling coffee mugs. And I probably should have used coffee mugs with some color or something, but you're selling coffee mugs. Not as straightforward as when you are creating a necklace, is there are more things that have to be considered when you're looking at the cost of your product. You have to buy raw materials. You have to manufacture the mug. You have to pay your staff in your manufacturing plant to create those mugs. You have to ship the mugs to your distribution center. So there's definitely more costs that are involved in that cost of product, but the formula is still the same. It's still revenue minus the cost of products equals your profitability. Okay, so now that we're all on the same page about what the definition of profitability is, let's get into how we can compare which of the products in your online shopping cart or online platform are the most profitable. If you're only selling one product, you can certainly use what we're going to talk about just to analyze the profitability of your one product, but we are also going to talk about how you, or what it is you're going to look at when you're comparing, when you have multiple products that you're selling. Okay, so the first step is you're going to establish a gross profit margin target. So we've talked about gross profit, which revenue minus cost of product. The gross profit margin is what you're going to hear very frequently in the e-commerce space. You're actually going to hear it in the retail space as well. And basically it is your gross profit as a percentage. And that's why it's called, and that's called your gross profit margin. So here is the formula. We're going to go through an example. For those of you that don't like math, basically your gross profit margin, and you'll see that same first section of what we looked at when we looked at gross profitability, is your total revenue less your cost of product. You also can refer to it as cost of goods sold. You will see those terms used interchangeably as well on various platforms and by accountants and bookkeepers. So that first top of this first part here is the same equation, your gross profit, total revenue minus cost of product. The difference is you're going to divide it by the total revenue and multiply it by 100 to give you a percentage. So let's look at an example. We're going to take that same jewelry example with the necklace. The total revenue was $35, and the cost of goods sold, and I think I used a different number, the cost of goods sold is $20. So your gross profit margin is 35 minus 20 divided by the total revenue, which is 35, and multiply it by 100 to give you a percentage. So on this example, where we're selling your gross profit of $35, or your necklace, you're selling your necklace for $35, we are making a 42% margin on that sale of necklace. Hopefully I haven't lost anybody yet. Any questions, please feel free to post them. And Steve, again, feel free to jump in as needed. Okay, so we've talked about, I guess the difference, the biggest definition is margin is best understood as the difference between the total cost and the cost of, let's rephrase that. Margin is best understood as the difference between the total sale and the cost of those sales. And then in this example, in this formula, we're just putting it as a percentage. Okay, so the question is, if you remember, point number one was actually creating a target, not just creating a, to calculate your gross profit. Well, what should your gross profit be? If you work out that the margin is 20%, is that good? Is that bad? If you work out that your margin is 85%, is that good? Is that bad? So here is the stat. Again, it depends on your location and your industry, but we're going to talk in kind of general terms that 45% is what Shopify and most industry experts say online retailers should have as their gross profit margin. So this is kind of at a minimum what you should be experiencing and calculating when you start to go through these calculations for your own products and your own business. Now that is significantly higher than if you had a brick and mortar retail store, which typically the gross profit margin would be between 20 and 30%. So it is significantly higher than if you're an e-commerce retailer. So any questions on the stat? Does it seem too high? Does it seem too low for you? And it's really an important concept because let's put it in perspective. So we're going to take another example. Let's assume that you are doing monthly revenue of 100,000, and I'm just going to look at my numbers to make sure that I say them correctly. You're doing monthly revenue of 100,000, and your gross profit margin, say, isn't at the 45% and is only 10%. So that means that you're basically earning $10,000 a month on $100,000 of sales. And that $10,000 a month is before you've paid any other expenses, before you've paid a salary. It's just based on the sales that are coming in and how much it's costing you to produce the product. So now let's flip this and assume that you've got a gross profit margin of 50%. So you still have the $100,000 in sales, but now you've got $50,000 is your gross profit before you pay yourself any salary or you pay yourself any expenses. So you actually have to do significantly less in sales in order to make the same amount of money if your gross profit margin is higher. And what I guess one of the most important things that this identifies for you is a lot of business owners focus on revenue. Well, how much am I making in sales? What are my sales numbers? But what's most important and what's going to keep your business alive is that you understand what the profitability is that's related to those sales. So that is your gross profit margin. Okay, so the other thing we're going to talk about now is we're going to talk about calculating the true cost of product. So we want to make sure that the selling price and what you're selling your product for is going to cover what it's costing you to produce that product. And in the two examples that we talked about earlier, there were different inputs, I guess, that were into the true cost of product. And we're going to dive in a little bit about what those, what kinds of things should be included when you're looking at what the items are that to be included in your true cost of product. So here is a list of some of the things that are most frequently captured when you're looking at how much does it actually cost to create my product. If you're building it yourself, your raw materials. So in the jewelry example, in the necklace example, it was, the cost of the chain, the cost of the hooks. The raw materials were the stones or the pearls that you put into the necklace. Any labor that's related to it. If you are paying staff, if it's your own time, make sure you are assigning a value to your own time and that you're not discounting that it's just you that's creating it. Doesn't mean that there's no cost to that. So do assign an hourly rate, I guess, to your own labor as well. Product cost. If you're not actually building the product, but you're buying it from someone else as a wholesaler and then turning around and retailing it, you would calculate the product cost from them. Sometimes that's all that people will consider, but if you're buying your product, let's assume those drinking mugs, you're not manufacturing them, but you're buying them wholesale from someone else, it costs you something to bring them in. That's what freight in is. Bringing it into your warehouse, into your distribution center, into your home if you're selling from your home. So freight in is a cost of that product. Make sure you're including it when you're looking at your gross profit. Freight out is if you are using fulfillment by Amazon and you're having to ship the product to Amazon, then that is an expense of your product. So you want to make sure that you're including that. If you have any imports or duties when you are bringing the product in, again, if you're buying a ready-made product, that should be included when you're calculating the true cost of your product. And the Amazon fulfillment fees and Amazon Shopify and credit fees are huge, or can be a huge portion and can certainly significantly affect your gross profit margins. So we always recommend that you do include those as well, because they do play a big role. And sometimes we've seen with some of our clients that they have eliminated and haven't looked at how much Amazon is taking out of their profit, that they believe they're making money, but it's actually costing them money every time an item is shipped through Amazon, because the fulfillment fees are so high that they don't have enough room in their product and their selling price to cover that, let alone to make a profit. So there are some examples of what you would include in the true cost of product. So let's go back to our two initial questions.
Sorry, before you go past that, could we just touch on product cost just a little bit here? One of the things that we've heard in the past from clients and from others that are in the e-commerce field is sales tax. Is there ever a time when an e-commerce retailer in Canada needs to include tax as part of their product cost? Or is it always, should it always be an input tax credit and not part of the product cost?
Great question. So in Canada, it is not mandatory for you to register for a GST or HST number until you hit a certain threshold, which I believe is 30,000. And we recommend for all of our clients, go out and register for that GST, HST number as soon as you open your business. Because then any GST or HST that you pay, and QST for our friends in Quebec, that you pay, you can get back from the government. So if you are registered for GST, HST, QST, you wouldn't include any of those sales taxes that you pay in your cost of product. However, if you aren't registered, then yes, sales tax would be a cost of your product. When you look at your raw materials, you would take it including the sales tax, because that's money that you're having to spend and you're not going to get it back, so it would be a cost of your product.
Okay, great. Thank you very much.
Okay, so the other thing you want to make sure that you're doing is that you're calculating the cost of your product on a per unit basis. You always have a selling price per unit, so this is how you're going to be able to compare your profitability across your products. Is you need to be able to calculate how much profit from and margin am I making for each unit of product. Not when I sell 10 of them, because sometimes when you are paying for shipping or freight in, you're shipping 100 items. You need to calculate what the shipping is for one unit, because that's what you're going to subtract from the selling price of one unit. So if we go back to our two initial questions, the first one was, does the selling price of your product cover the true cost? So now that we've listed a whole bunch of things that you should be included or be including in your cost, does your selling price cover all of these? Do you know? Good test is actually go through this exercise and make sure that your selling price isn't too low and that it covers, at a minimum, covers all of these, but covers these plus gives you some profit at the other end. And then the second question that you want to look at is, what does your selling price have to be after you take all these costs into consideration to come up with a gross profit margin of that targeted 45%? Is it high enough? Is your selling price high enough? Can you cut back on any of the costs that are included here? Can you negotiate discounts on your product cost or your freight in? Can you get bulk pricing with your raw materials? Anything? Can you register for GST, HST and have that not be a cost of your product anymore? Because if you can alter either your selling price or your cost of products, both of them are going to affect your gross profit margin and your profitability. And Steve, I don't have anything on my screen that's telling me time. So if you can just let me know if we're kind of behind schedule, ahead of schedule.
No, we're in pretty good shape right now.
Okay. So we looked at gross profit margin was the first thing you're looking at. The second one that you're looking at is your true cost of your products when you're doing your calculations. And the third one we're going to look at is your customer acquisition cost. So this is, by definition, is the cost of acquiring a customer for each of your product lines or each of your products. Marketing tends to be a fairly significant cost for online retailers because you don't have foot traffic as you would with a retail brick and mortar store. So you want to make sure that you are looking at this expenditure in relation to your products. Okay, so another formula for you. And I know everyone is probably saying, well, I didn't get into e-commerce so that I could do math. So you need to get yourself a good bookkeeper, a good accountant who loves the math piece, or sit down and work these out once at least so that you have a baseline to get started. Okay, so formula for customer acquisition cost is the total marketing expenditure you have in a month divided by the number of new customers that you acquire in a month. So this is a really simplistic formula. Again, we're looking to get you started on the process. We're not taking into account that you can upsell somebody or that you've got lost leaders or anything like that. We're looking at some fundamentals to get you started in the process. So if we take an example, you've got product line A, let's assume the necklaces, that we spent on either Amazon ads or Shopify ads or Google AdWords. We spent $500 in the month to try and get people to our shopping cart to buy our necklaces. And in the month that we obtained 100 new customers. So if we look at the formula above, our total marketing spend in the month is $500. Number of new customers is 100. Divide 500 divided by 100. So it basically costs us $5 to get a new customer. Does that make sense? Okay. Really, I need feedback. I need feedback from people. Okay. So $5 sounds like, that's a really reasonable customer acquisition cost, right? It costs me $5 to get a new customer. Well, if you're selling your product for $10, yeah, that's not bad. If you're selling your product for $100, even better. But if your product is selling for $5 and it's costing you $5 to bring in a new customer, well, then that doesn't really make any sense. Or if you're selling your product for $2, but it costs you $5 to bring in a new customer, you're actually losing money every month because it's costing you more to get a new customer than what you make from that customer. And again, remember that we're not talking about upselling, and we're not talking about any of the, the things that you can do to offset that. That's probably going to be a topic for another webinar. But just looking straight at how much does it cost you to bring in a new customer and what is the product that they're buying. You want to look first at what is the product that they're buying with the revenue dollars, but you also want to look at after the gross profit side of it. After you take your costs out, so you've got a $100 product, you take your costs out, you've got $20 left, does the cost of customer acquisition still make sense? Okay, so now we're going to do a comparison. So once you've gone through this exercise and you have 3 solid metrics for your products, you're going to put them in a chart side by side and you're going to compare them. And that's what we're going to do. Again, we're going to carry through this jewelry example only because it's the most straightforward. Otherwise, I think all the numbers that were in the boxes would probably make your head explode. So here's 3 products that we're selling. And if you look at these 3 metrics, which is the product that you want to spend most of your marketing dollars on because you want to sell them the most? So if we look at necklace A, and we've got our gross profit margin. So our selling price is $35 for the necklace. Our cost to produce the necklace is $25. We're dividing it by the selling price. So our margin on necklace A is 42%. And it costs us $3 to get a new customer for every necklace that we sell for necklace A. Move on to the second product that we're selling, necklace B. Selling price is the same, it's $35, but it only costs us $15 to produce the product, divided by the selling price of $35, and our gross profit margin on necklace B is 57%. And let's assume that it's the same cost of customer acquisition. Whether they buy necklace A or necklace B, it costs us $3 for every necklace buying customer to come through our store. And then the third product that we have are earrings. So we sell the earrings for $8. It only costs us $1 to make the earrings. Divided by the selling price of $8, our gross profit margin is 87% on those earrings. And based on the metrics and the measurements that we've done, it costs us $1 for every new customer to come in to buy earrings. So if we were to look at these 3 products, which one should you be selling or driving and putting your marketing dollars behind to sell? So you might be surprised that it's actually the earrings. The dollar value of each sale is smaller, $8 versus $35. Most e-commerce retailers would say, well, I should be selling more of the $35 items, not the $8 item. But you actually have a bigger bang for your buck for the more earrings that you sell. Your profit margin is higher. It costs you less to get that customer, so you're even leaving more money in your pocket after that. So the earrings should be the product that you're going after to try and sell the most. If we just look at the necklaces between necklace A and necklace B, again, you might be thinking, well, I sell them both for $35. It doesn't really matter which one I sell, but it does, because on necklace B, it costs you less to make it. So you're actually making more money on necklace B. So this really, I think, although it's a very simple example, highlights where you're not focusing on the sale amount because it's not as relevant to making a decision as to what you should be focusing your energy and what products you should be focusing on selling, where your marketing dollars should be going. So in your necklace example, you want to focus on necklace B. Across all of your products, you want to be focusing on your earrings.
And I think, the one thing we should mention here is that obviously we are only using them as examples to make a point. In the world of reality, we may know from our business that necklace A is our number one selling necklace by far, because there's a much bigger demand for it, that more and more people want that particular necklace. So we sell a lot more of them. But what we're saying is, when you know this information, it then makes it easier for you to determine perhaps where you may want to put some of your advertising and marketing dollars so that you can increase the sales of necklace B and the earrings, so that your overall average gross profit margin increases. So we're not naive to believe that this is the world of reality, but these are great examples to make a point as to why you need to know this kind of information so you can better manage your business.
Absolutely. And one of the things that it also is going to help you do, as Steve said, is it helps you identify across your multiple products, what are your core products that you want to make sure that you have on hand all the time, either from a profitability standpoint or because they are in demand. So it helps you also determine what are your core products, but what are your growth products. It also, if necklace A is your best seller, do you need to try and negotiate to bring down those product costs to increase the profitability because it's such a strong seller? But again, you can't make any of those decisions or have those conversations until you know what those numbers are. And again, we haven't touched on, we've looked at some basic fundamentals, but sometimes you have a loss leader where you want to sell something at a lower price to bring them in to buy something else from your shopping cart. We've not addressed that. Average order value. When you know that your customer buys one thing, that they typically also buy this, and this, we're not taking that into consideration. And inventory turns. How often and how frequently can you get your inventory and get your products? Also not something we've considered. So although we've only touched on 3 metrics, they're really the foundation for the other pieces that you should be looking at when you're looking at your sales. And if you don't have multiple products and you only have a single product, the metrics still matter to you, because you wouldn't necessarily do the comparison piece, but you would be able to tell whether or not the product you're creating and selling, is it profitable? Is it giving you the dollars that you need in order to make your business sustainable? So, and it also will help you tell you what you need to do in sales in order to get that bottom line and pay yourself the salary that you want. So they are still very important. And, depending upon the size of your e-commerce store will also determine what the size of your marketing spend is. And we usually recommend, again, depending on the size of your business, that you're looking at the monthly numbers, or you're looking at the numbers and profitability monthly, only because if you're selling on Amazon especially, there are new fees and changes in fees that are coming up, I'm going to say weekly, if not monthly at a minimum. So you want to make sure that if you need to adjust your prices, that's something that what's happening to your margin, based on external factors. With the exchange rate, with the US and the Canadian dollar, that can also significantly affect what it's costing for your products if you're importing pieces from the US or from abroad, or if most of your sales are in the US, then that exchange rate is going to be a significant factor for you as to what that revenue number is. So at a minimum, you should be looking at these quarterly, depending on the size and the volume of your store. For our clients, they're looking at the monthly. And it also then allows you to create an actionable plan of how to increase your sales, how to increase your marketing, what products you want to focus on. Okay, so now I'm going to open it up to questions. I've been talking a lot and haven't really been having a chance to breathe there. So I'm going to open it up to questions. We put our contact info on here. If you want to reach out to either Steve or myself after the fact, please feel free to do so. Our website is on there. And Steve, I'll let you give a shout out to your podcast.
Yeah, no, absolutely. Thank you. We started a podcast actually just a few short months ago. It's been going great. And it is a podcast for entrepreneurs. So it's a weekly podcast. Each week we bring on a guest who is an entrepreneur with an entrepreneurial background to share their journey, their learnings, their experiences, their challenges in order to help other entrepreneurs. So we hope you check it out. It is at smartmansmarterwoman.com. You can also find it obviously on Apple, Spotify, all the usual places. But we'd love for you to check out at least one episode and see if you find some value there. We very much try with each episode to share at least one or two gold nuggets that can help you in your own entrepreneurial journey, no matter where you might be in that journey. So please check it out. I do have a couple of questions here, Juliette, if we could get to them.
Sure, absolutely.
Well, one of the first ones is that is there any way in QuickBooks to run reports that will show me for some of these things we've talked about here? For example, can you run a report that would show me my products sales by profit so that I can run a report and see that here are my top 5 most profitable products?
Great question. So in most accounting software, and again, QuickBooks is no exception. So I don't know if you're using QuickBooks Desktop or QuickBooks Online. Honestly, it doesn't matter. You have the ability to get that information out, but you have to put it in somewhere. So I'm going to talk in the QuickBooks world, in the QuickBooks lingo, but it will apply to whether you're using Xero or Sage or anything else. When you buy a product, when you sell a product, you're using in QuickBooks, you're using an item, a product or service or an item. Take my necklaces for an example again. So when you sell the item and you're creating the invoice, you're using that item for your $35 sale. The only way that QuickBooks can tie that to a cost is you actually have to, with using that same item, put the expenses that are related to that cost to that same item. Then yes, you can run a report, which is, I think it's actually called item by profitability, and it will show you the cost and the sale netted against each other. But the only way it can give you that report is if you're putting both of those pieces of information into QuickBooks. Okay,
great. Thank you. And one last question here, and this is a big question. I'm not sure we have enough time to answer this one. Probably a topic for a webinar all by itself. Okay. But the question is, my margin is way below 45%.
Yeah.
What can I do to increase it?
Okay. If you go back to what that formula was, it's revenue minus cost of product. That's basically what it comes down to, those two numbers. So either you have to change one of those two numbers to change your margin. revenue, either you increase your selling price, and sometimes you can't do that because it's based on, what's happening in your marketplace, what your competitors are doing. But is there something that you can do to increase that selling price? And sometimes if you can make a small change to both numbers, you're going to get an exponential increase on your margin. So look at your selling price. And then on your cost of your products, if you have a strong understanding of what all the costs are there costs that you can reduce? Can you speed up how fast it takes to make one of them, which reduces your labor cost? Can you, as we said, can you buy your source raw materials in bulk, get a discount, and bring down the cost of your product? So basically, to change your gross profit margin, it's either one of those two items. Those numbers have to change.
Yeah, no, great answer. I mean, when we had our own e-commerce business, what we were constantly trying to do, obviously, manage our expenses, improve our selling price whenever we could. But what we also tried to do is we tried very hard to find products that we could get, if not exclusively, but certainly a market area. And so, because if there's a product you can sell and develop a demand for that product, and there's not 100 other people selling it, the chances are you can get a little better selling price for it. So the more exclusive, and obviously if you can, design and build your own product, that you're the only one selling it, then you have great control over the margin. But as Juliet said, when you're selling products and there's 50 other people selling the same product, it's very, very difficult to increase your selling price. So then the management of your expenses becomes really, really critical. And like I say, just keep trying to find products that will sell for you, but they're not readily available in lots of other places. And those are really, the secrets to increasing your margin. And that brings us to the end of our webinar. So thank you very much for joining us today. Hope you found some value here. If anyone is interested in a complimentary assessment of your current bookkeeping and accounting system, in other words, if it's not doing for you what you need it to do, we'd be happy to give you a free consultation. Just shoot me an email, steve@aissolutions.ca, and we'll let you know what you can do to improve it so that you can get the information you need.